Hello all, welcome to Moneyfy Mantra, a knowledge series by Tata Capital Moneyfy. Moneyfy is an all-in-one personal finance management app with a wide range of offerings like mutual funds, equity baskets, bonds, NCDs, corporate fixed deposits, and also various kinds of insurance, credit cards, and loans. Basically, everything in the personal finance sector. We also provide goal-based investment options where you can create a personal goal and invest towards it. I am delighted to host this special episode of Moneyfy Mantra with our guest Abhijit Roy. He is the CEO and co-founder of GoldenPi Technologies. He is recognized as one of the proponents of his field in the fintech industry. He founded GoldenPi after a 15-year long journey with a mission to make the fixed income investment market accessible to all retail investors in India. Welcome to Moneyfy Mantra, Abhijit.
Thanks, Anthony, for the generous introduction, and it's great, to be on this discussion with you.
The pleasure is all ours. So let's get started. So we will be asking the most pressing questions that our investors generally have regarding the fixed income market. And since you're an expert on that field, I'm sure we will be able to give a very good lucid explanation on all of these. Okay, so let's get started.
Sure.
Fixed income investments are a relatively unexplored investment avenue for most retail customers in India. So keeping that in mind, could you please explain to the customer, to our viewers, what is meant very plainly, what is meant by bonds, non-convertible debentures or NCDs, and corporate fixed deposits, and how can they invest in these instruments? How is it done?
Certainly. Let me start off, with laying out what are fixed income investment options, because we see at times investors struggle to understand this term, right? So fixed income investment options are the investment avenues where an investor invests money and gets fixed returns for a certain period of time, right? The most popular fixed income option available in our country, right? And probably, literally, the only fixed income option which is available to retail investors, the Indian middle class, are the bank fixed deposits. But then, there are a host of other fixed income assets like bonds, debentures, corporate fixed deposits, NCDs, right? Which also give fixed returns. So all of them form the fixed income market. Now coming to your question around what are bonds, debentures, what are NCD IPOs, and what are corporate fixed deposits. The top three fixed income assets which are available in the market that investors can look up to beyond bank FDs. See, bonds and debentures are essentially a way for entities like the corporates, the central government, the state governments to raise capital from institutions, individuals, right? And in exchange of that, they issue financial securities. These financial securities are termed as bonds and debentures. They come with a finite holding period, say 3 years, 4 years, 5 years, whatever be it, right? Or even larger than that. And against this borrowing that the entity has done, the entity will promise a fixed return to be paid out annually till that particular bond or debenture matures. So that's for bonds and debentures, right? NCD IPOs are basically a format of debentures itself, but they are the first time when a particular debenture is being issued by a corporate, right? Wherein retail can invest in them at ticket size of as low as 10,000, right? They are termed as NCD IPOs or non-convertible debenture IPOs. In plain words, it's the first time or the primary issuance of these debentures that are being done by a corporate in the market, making it available to the public for investment, right? Moving on to the third asset class, but it's corporate fixed deposits. Corporate fixed deposits are just like bank fixed deposits, with the difference that they are issued by corporates and not by banks, right? So there is a certain category of NBFCs in the country, right, which are termed as a deposit taking NBFCs, who have the permission from RBI to be able to take money from investors, individual investors, and pay them, fixed interest, just like a bank FD would give. Some of the popular examples would be like Bajaj Finance FD or Shriram Transport FD, right? So that's in brief about these top three fixed income asset class.
Okay, that was a very, very clear and concise explanation of the critical fixed income securities that are available to us. So, having said this, if you can just encapsulate the risk reward equations associated with these instruments.
Sure. So let's look at the rewards that would be there in these fixed income options. Let's start off with bonds and debentures, right? The first thing is that when you invest in bonds, right, let's say government bonds itself, which is issued by RBI, right, for a 10-year GSEC paper, you would get anywhere between 7.2 to 7.3 percentage annualized returns, right? And then on AAA rated papers, anywhere between 8 to 8.5%. It keeps on increasing, right? Till if you go up to A rated papers, which is the credit rating of the papers, right, you can expect to get as high as 12 to 13%, right? Now, so which means you are getting returns which are higher than the traditional bank FD rates. Number one. Number two, bonds pay out regularly on a certain frequency, which can be on a monthly basis, quarterly, half yearly, or an annual basis. That means they can build up a steady source of cash flow for you, a steady source of income for the investor. Third is, they are an excellent option to diversify the investments of an individual investor, beyond equity, mutual funds, bank fixed deposits, right? And fourth, it is to be borne in mind that, at maturity, bonds and debentures would return back the amount which has been invested by the investor of the face value, right? So there is a capital preservation which is built into this particular asset class. However, we can see various types of bonds and debentures wherein it can be senior, secured, unsecured, right? We can get into the nuances of that in a separate discussion, right? Those are the benefits. Now, coming to the risks that are involved in bonds, right? And it is very, very important for investors to know about the risks involved in any investment asset class, and it holds true for bonds and debentures as well. The first one is the default risk. It means that if I put my money as an investor into a company that is not doing well, right? I invest in the debentures of a company whose financials are not doing well, right? There is always a probability that one, the company might not be able to pay me back the interest that it has promised. And in the worst case scenario, it might not be able to return me back my investment capital also, right? That means my money is lost, right? So that's default risk. Second risk is the liquidity risk. So the liquidity risk means that if I, as an investor, I am holding bonds in my portfolio and tomorrow I want to sell it, right? I might not be able to get a buyer immediately, or I might get a buyer who is offering a price which is not matching my expectation. That means I'm not being able to sell off right away, right? That is a concern of liquidity, right? The third one is an interest risk. What interest risk means is, and it's become real. It's no longer a theoretical risk. It's actually a real risk for individual investors as well. And that is, when RBI changes rates, right, the bond prices gets impacted. If rates increase in the market, bond prices fall. That means the bonds become cheaper, in the market, and you can go ahead and get better returns on them. But then somebody who would have purchased a bond, and let's say there's a dire necessity to liquidate, at that point of time he might be getting a lower price in the market because interest rates have gone up, right? At the same way, the reverse is also possible. When the interest rates go down, bond prices go up. So once who are holding them, if they go to sell in the market, they will get a capital appreciation, right? That's something that can be expected. So broadly, these are the risks and rewards for bonds and debentures. I will mention about uh, for NCD IPOs also. Few additional points are there. One, in NCD IPOs, retail can participate at as low face value as 10,000 and then multiples of that one, making it a very affordable investment option, right? And it is completely through a digital journey of UPI, making it very easy to invest. The risks would remain the same as what I mentioned for bonds and debentures, right? For corporate fixed deposits, uh, one primary factor that needs to be kept in mind is that they are unsecured, right? Like in banks, right? There is a securitization which is provided up to 5 lakh on the deposit. But in the case of corporate fixed deposits, there is no such securitization, right? So it is always important that if somebody is investing in CFDs, right, and they're getting better returns than the traditional bank FDs, they should always invest in very good quality companies which have got very good credit ratings. So that's in short about the risks and rewards on these asset classes.
Correct. So I think, portion of the risks that you mentioned for bonds and NCDs and all are to do with early exit, at the time of early exit. So
Yeah, yeah.
most people actually go for holding till maturity strategy, right? So they
Correct.
buy a bond and they wait till maturity.
Correct.
So a lot of some of the risks that you mentioned don't apply to those investors.
Absolutely. That's correct, Anthony. I want to emphasize this point for individual investors, retail investors, right? Bonds are like an asset class wherein money is to be invested and held till maturity. When you do that, the risks that I talked of, right, the interest rate risk or the liquidity risk, nothing appears. Your returns are fixed till maturity, and till the last decimal place what is the interest money which will be deposited into your bank account as per the payment frequency, right? And what is the precise date on which the bond will mature, and you will get back your the principal amount, basically the face value of the bond, back to your bank account. So it is a very predictable, well defined instrument, and serves as an excellent option beyond bank FDs.
Absolutely. I mean, I completely agree with you. I mean, it's still, it's, there's a lot of room for to grow, I think, this market in India as far as retail participation is concerned. And I think your platform, I think, is taking the right direction in informing the public and getting more retail participation into the sector. So, speaking about the fixed income securities market, so how has this market formed in India over the past few years? And also, can you throw some light on how big the fixed income market is? Our Indian fixed income market is.
Right. So, see, the fixed income market in the country can be divided across asset classes, right? Uh, Bank fixed deposits, right? Then bonds and debentures, then commercial papers, corporate fixed deposits, certificate of deposits, sovereign gold bonds, right? These are multiple asset classes which form the fixed income market in the country, right? Now, how have they evolved? Right. We know bank deposits have been one of the most dominant investment vehicles since independence of the country. But since 2015 onwards, right, there have been rate cuts, right, and the bank deposit rates have come down to pretty low levels. Wherein if I compare today's bank deposit rate of, say, State Bank of India for a 5-year tenure, it is at around 6.5-ish, right? Whereas if I compare that with the rates that will be available in 2009-10 during that period, right, it was in the range of 9 to 10%. But then this becomes a struggle for the Indian middle class, wherein they have always been putting their money into FD. And now, because of these low rates, right, they are looking for alternate avenues or fixed income which they can invest into. And this is where these other investment options like bonds, debentures, corporate fixed deposits come into the play. Now, coming to the size of the overall, bond market and how has it played out, right? See, bonds have been an integral part of our financial system since ages, right? The total size of the bond market in India as of date is around $1.8 trillion, out of which $1.2 trillion are contributed by the central government securities, which is like the GSEC, SDLs, T-bills, right? And the remaining $600 billion are contributed by the PSUs, the corporates, the banks, right? So it's a massive sized market, not much known to the Indian middle class, right? But with the need coming into the market now, the financial system, right? People are now getting more aware and looking at these asset classes for investments. Now, the growth of the bond market per se, has seen a healthy growth of around 12% year on year, right, for the past 4 to 5 years. And as we see, the upward curve in the growth continues based upon strong government backing to widen and deepen the bond market. The regulators, both SEBI and RBI, right, putting in proper frameworks and policies so that retail can participate in them, right, and with getting proper protection in case of any issues, right. So there has been a lot of support from the overall ecosystem in growing the bond market in the country. And I firmly believe that it is going to grow, right, multifold from here onwards as we see retail participation increasing more and more into the specific asset class.
Yeah, absolutely. I totally agree with you. The recent change in the minimum possible ticket size to 1 lakh, I think, is absolutely the step in the right direction as far as making it accessible to the retail
Yeah.
public, right? So when a typical retail investor starts to look at bonds and starts exploring the whole market, there are a lot of terms like coupon rate, holding till maturity, like I said earlier, right? Face value. So, I mean, that can be quite off-putting for someone trying to enter into something. A lot of jargon, right? So, could you demystify these for our viewers?
Certainly. See, what I would want to do is pick up the most common terms, right? Just a handful of terms,
Yeah.
which are the most important ones that is important for an individual investor to know for their investment decisions. So let me pick up the first one, face value. The face value of a bond is the value of one single bond at which it is issued by the issuer for the first time, right? So let's take there's a bond that is being issued by, say, National Highway Infrastructure Trust. I'm just giving an example of an entity, right? And it issues a bond through the NCD IPO route. Then the face value for one piece of bond, right, would be 1,000 rupees as an example. Next is a coupon rate. Coupon rate is just similar to the bank FD rate. This is the rate of interest that the bond would be paying to the bondholder annually till maturity. So let's say for the bond under question, the rate of interest is say 8%, 8.5%. I'm just giving an example, right? So that means if I hold 1 unit of 1,000 rupee bond, right, then I'm going to get the 80 rupees to 85. I mean, let's say it is 8.5%, then I'm going to get 85 rupees on the 1,000 rupee bond annually, right? The next term, which is important to consider, is the maturity date or the call date. Maturity date, as it means, simple to understand, is a date on which the bond will mature and the face value of the bond will be returned back to the bondholder. Call date is similar to a maturity date, but with the option that the issuer has got the right to exercise calling back that bond, or if they don't want to, they can continue the bond further beyond that date. That is a call date. The next most important parameter would be the credit rating. So how do I understand, in one glimpse, whether a bond is, good in quality or is poor in quality? One quick check, though not the only one that one can do, right, is a credit rating. So there are credit rating agencies, which are independent bodies who examine a bond that are being proposed to be issued by an issuer, right? Look at what is the bond going to be used for, the money, what is going to be the tenure, what is the management quality of the company, a host of those parameters, and then they give a credit rating. AAA being the highest, and then it is AA, A, triple B, B, C, and then D. D means default, right? Some of the popular credit rating companies in India are CRISIL, CARE, and ICRA, just to name a few. Yield to maturity. This is another important term. What this means is, what is the effective returns that an investor will make on investing a particular bond, right? This is very important when people are buying bonds from the secondary market. Why? Because when somebody is buying a bond from the secondary market, they can be either getting it at face value, at a premium value above the face value, or at a discounted one, depending upon at what price one is purchasing at, right, and holding till maturity, right, the returns are defined on that. So yield to maturity is a measure of that final return that I'm going to make, and it's an important parameter to consider to actually understand what returns to get. And last but not the least, payment frequency. What that means is, what is the frequency in which the coupon payment will be done by the issuer to the bond holder?
Correct. Okay, so Tata Capital Moneyfy has recently partnered with GoldenPi Technologies for giving our customers access to the fixed income market that we discussed today. So could you give us a brief about GoldenPi and your journey towards co-founding GoldenPi as the sort of fixed income marketplace that we have?
See, I started GoldenPi in 2017 with my other co-founder, right? And it started from a very personal requirement in the family finance, right? So there was some amount of money which was stuck into bank FDs, and this was in 2016-17 period, right? And I was examining what are the other alternate options that might be there to displace it, because the FDs were getting very low returns at that point of time. During this course of discovery, I came across a multiple of these alternate options, and I eventually invested in bonds and debentures. But then during this investment process, I realized that getting access to bonds and debentures and even knowing about what are they, where to invest, right, is totally opaque for the Indian middle class, right? It was outside the limits of the normal retail investor, right? And it seemed as a problem worth solving, because literally every Indian household, right, has got an FD, right, and that's at pretty low levels, and they are looking for alternate options which will be giving them better returns. Bonds and debentures are there, NCD IPOs, corporate fixed deposit, they're all there. But literally what people have access to are traditional bank FDs. So we took this as a mission to build a business around this, wherein it will be a digital platform on which these other fixed income assets will be readily available to investors. We'll spread investor education and awareness amongst investors, and give them ready access to these options, and enable them to invest to a completely digital journey. So that's been the journey the mission with which we started. Today we are a 6-year-old company, and We have host of options like secondary market bonds and debentures, corporate fixed deposits, sovereign gold bonds, NCD IPOs as fixed income assets on the platform. And we'll keep on adding more asset classes which will add value to the Indian middle class for their investments. Now, I would take the opportunity to express my sincere thanks to Tata Capital for giving us this opportunity for this partnership. The Tata brand has been synonymous with doing good for the people and the country at large. We at GoldenPi, we strongly believe that the struggle that the Indian middle class has with low yielding bank FDs, right, is a problem worth solving for. And we are truly delighted and super excited to have got this opportunity to partner with you, Tata Capital, in serving this purpose.
Thank you, Abhijit. So this was an extremely insightful session for our viewers, I'm sure. So we thank you for your valuable time, spending your valuable time, taking time out for this session. To to all the listeners, hope you download the Moneyfy app, and where you will find all the offerings that we discussed today, right, and many more. You can download the Moneyfy app by clicking on the link given in the description below. So with this, we have come to the end of our session today. Thank you for listening.
Thanks, Anthony.